Three growth stocks to buy near their 52-week low. I know growth stocks right now are not too hot. A lot of you guys are hating them. You wish you never bought them. But this is how the cycle plays out. Most people, they love the volatility with growth stocks, but only on the way up. So whenever the stock goes up 50% in 2 or 3 weeks, it's fine. They love it. But if it starts going down 50%, then they start looking for the news on why it's going down. They call it a piece of trash and all these kind of things. And my strategy in the market is to buy what people hate and sell them when they love them. So I told you guys before about a lot of the defensive stocks. I talked about Pepsi, a lot of, REITs, a lot of those kind of stocks. I had some defensive stocks in my portfolio. They've been going up as the market's going down. So I've been rotating out of those stocks and I'm starting to sell put options on a lot of the growth stocks down 20, 30, 40, even 50% from their all-time high. And that's my strategy. Buy them when they hate them, sell them when they love them. Now the growth stocks are being hated and I'm starting to see a lot of opportunities. 1 to 2 years from now, people will look back, they will start loving the growth stocks again. And by then, it's going to be a little bit too late to buy them. So I'm going to share 3 stocks that I've been looking at on the screener, trading at near 52-week low. This is on FinViz. You could research stocks at their 52-week low. And I look at the screener almost every weekend. And, I've been finding a lot of stocks, but you guys asked me for an analysis on 3 stocks. I'm going to talk about them: AMD, Elf Beauty, and Robinhood, which is a very interesting one. So I'm going to discuss all 3 very quickly in this video. I try to make them quick so I don't waste your time. And I really hope you enjoy it as always. The first one is AMD, of course. It's down 53% over the last year. I did make a video on AMD when it was trading at $120 per share. And I said AMD is presenting an amazing buying opportunity. Today, AMD is sitting at $98 per share. So far, this call has not been playing out, and so far I have been wrong. I like to admit that. Maybe I'm not wrong on the fundamentals so far, because the fundamentals are still intact. But in terms of my call on the stock being a good buy, it hasn't been playing out. Maybe it's just because the market is going down, everything's going down together, but I like being fair and I'm a little bit hard on myself, and that call has not been playing out so far. But we'll see how it plays out over the next, 6 months, year or 2 years, and then I can get back and make a judgment. But in terms of the fundamentals, last earnings report, they did very good. Earnings per share beat $0.09 versus $0.08. They also beat our revenue, which was pretty good for the company. They expect $7.1 billion in sales for the first quarter versus the analyst expectations of $7 billion, which was a decent beat even on guidance. But the main reason why the stock went down is because they kind of guided down on data center and mainly a lot of their AI kind of sales growth. It was a little bit slower than the analysts were expecting, and that's why the stock went down. Despite data centers, which is where the AI segment is, it's still growing 69% year on year. This is massive growth for the company. So the client segment, where they have the PCs, now they have the AI PC kind of tailwind with Dell and a lot of different partners. They are partnering with AMD. AI PCs are going to be huge. And this one's up 58% year on year. And their other segments have been stabilizing. Now, to keep the video short, AMD right now is trading at 21 times earnings. 21 times forward earnings is one of the lowest valuations AMD has traded at. Now, it did go as low as, I believe, 17 or 16 times earnings in 2022. Now it's trading at 21 times. I'm not sure if we're going back to 16 times now with the AI tailwind and with all the growth that's expected from AMD, over 42% in 2025, 34% EPS growth in 2026, 19%, 29%. NVIDIA has the same estimates, and a lot of the big 7 have kind of put up their earnings reports, and they're all guiding high in CapEx. Amazon is going to spend $100 billion on CapEx. I believe Meta is spending $60 billion, Google is spending $80 billion, and a lot of those stocks are just increasing their CapEx spending, and they're not slowing it down anytime soon. And Microsoft said it themselves, they're not slowing it down anytime soon. So all those things are tailwinds for AMD and NVIDIA, and the companies are going to benefit from them. But with AMD trading at 21 times forward earnings, expected to grow 40 to 30 and 20%. It's trading almost at a half peg ratio, half price to earnings growth. And this is extremely cheap for the company. And I still believe the company is presenting an amazing buying opportunity at this price. But a lot of you guys have been asking me about AMD. And I'm going to be honest, guys, the gap between Nvidia and AMD for valuations have been closing. So now AMD is trading at 21.5 times earnings. Nvidia is trading around 25.5 times earnings. So if you really want to buy the leader in the industry, you could pay 4 points more and buy Nvidia instead of AMD. But if you want something with better kind of turnaround prospects, something that's hated, something that could really make a major comeback and have explosive moves to the upside, I think AMD has this potential better than Nvidia. But if you want something for the very long term, you like buying the leader in certain industries, the valuation gap isn't as wide as it used to be. It's only 4 points right now. So you can maybe own both, or you could choose between two of them. I'm not hating on AMD because the stock went down, and I still believe the stock is presenting an amazing opportunity. But if you like Nvidia, I mean, the gap is not too wide, and I would leave this decision up to you. But for me, the fundamentals are still intact, and again, you see the gap closing down, and to me, nothing really has changed with the company. The second one, which I talked about many times, and I did a video on it, a lot of you guys have enjoyed it, and that was Elf Beauty. And you asked me for an update. Elf Beauty right now is sitting at $64 per share, and I made a call on the stock after it was down so much at 63. I told people the stock was not a buy, and I believe it's worth around $58 per share. And that was not easy to do because, I mean, the prospects were for the stocks to rise because it was down so much. But I still believe the stock was expensive. And so far, my call on the stock has been playing out. But the main reason why ELF is going down so much, it was one of the best stocks of all time. Now it's a disaster, mainly because of revenue growth. It's been massively decelerating. The same thing has happened to Celsius, and the same thing is happening to Elf Beauty. It went from 5%, 12%, 23, 47, 76. Now it's going to be 27%. 2026 is going to be around 10%, 11%, then mid-single digits, 5 or 6%. This is extremely low after growing 76%. The company had to take a massive multiple contraction. So now they're expecting 27%, but then in the second half, they're expecting 14 to 16%. So this is a massive deceleration in growth, and that's why the stock is getting killed. Now, again, to keep the video short, I took the analyst estimates or the company's own guidance for this year, and now they're in Q4 of their fiscal year 2025. So this is for this year right now, is $3.33. So I used the $3.33, and I put in 12% earnings per share growth over the next 5 years. Now, the analysts are expecting 10%, 15%. Revenue growth is expected to be 10% to 11%. So I believe something around, 12% growth is fair. It could grow a little bit higher, maybe 15%, but I would say 12% growth is fair. In total, I would get $5.87 in earnings per share. Now, if we look at the PE ratio, it's now trading at 18 times earnings. 18 times earnings is one of the lowest, lowest valuations Elf Beauty has ever traded at. But I believe if the company is going to grow 10 to 12 times, 10 to 12% earnings per share, I would expect the PE ratio to be around 18 times to maximum 20 times. I would not bet on the PE ratio going back to 35, 40 times earnings. I think those days are over. So if I take this earnings per share of 587 for the next 5 years, and I time it by 20 times earnings, which is giving the company a slight multiple expansion from the current 18 time multiple to 20 times. I time it by 20 times. This is $117 per share 5 years from now. If I'm trying to get a double on the stock over the next 5 years, I would have to buy the stock at $58.70 per share. Now the stock is trading around $64. So I believe Elf Beauty is starting to look very interesting. My fair value is still $58, and this is being conservative. The company could grow earnings per share maybe 50%, 60%. Maybe the PE ratio could be higher. But being on a conservative kind of estimate for me, I would say anywhere close to $58 is presenting an amazing opportunity on Elf Beauty if you really want to own the company. Okay, now the last stock I'm going to review, and I haven't really reviewed the stock for over 2 years. I mean, the last time I looked at it was 2 years ago. And I'm very, very impressed with the company. And I wish I bought the stock. And this stock is Robinhood. Robinhood is down, I mean, around 31% from all-time high. It's still up 13% this year alone. I was shocked to see that Robinhood has 25 million funded customers. 25 million. I mean, the US population is 360 billion. The adult population is like 220 million or 250 million, and they have 25 million customers. That's like 10% of the adult population. This is insane. I mean, I was not expecting so many people to be on Robinhood. I guess that's why we had a bubble in the stock market with 25 million people being on Robinhood. 2.6 million people being gold subscribers, where I believe they pay $10 a month or $5 a month. They get higher interest and all these kind of things. Robinhood still sees a massive TAM for them, which is over $600 billion. It would be 200x from their total revenues right now in 2025, and they're expecting to get there by expanding crypto trading, expanding them to being an international brokerage where you could buy international stocks on Robinhood. You could do a lot of things with institutional investors, international credit cards, global neo-banking, and all these kind of things. And they could get to $600 billion in total addressable market, which would be amazing for the company. And the company has been executing. They have retirement accounts. They've been moving away from shorter-term trading and trying to diversify into retirements and IRAs and things that are a little bit more stable. Now, my main issue with Robinhood is if you look at the last quarter, it was amazing. You know, the total revenues, they grew 115% year on year, 115%. But this is when we had a lot of the excitement around the new president, around cryptocurrencies, and all these kind of meme coins were pumping. And it was a euphoric time in general, okay? Now, if you look at the revenue breakdown, $672 million of their revenues is from transaction-based revenue. So it's based on volume, it's based on shorter-term trading. $296 million is on net interest revenue. And you can see how the transaction revenue was so high that it was almost higher than the total revenue over the previous 3 quarters. This is speaking bubble territory to me. And if you look at the transaction revenue breakdown, most of it was actually in cryptocurrencies. $358 million was in cryptocurrencies versus $61 million for the prior quarter. So this is massively unsustainable. Options, $222 million. Equities were only $61 million. Options were almost 5 times equities. And all these things, again, they're very hot whenever the market's going up. They're very hot when we have a certain kind of bubble. But if the market keeps going down, if the market keeps getting weak, a lot of retail investors, they're going to give up on option trading. They're going to give up on those meme coins and Doge or whatever and all these kind of coins. And that's going to be really bad for Robinhood. So Robinhood is a beneficiary of bull markets. If we have a bear market, we have certain weakness in the economy, in the stock market. Robinhood is not going to do too well. And that's why, for me personally, in terms of those fintech kind of platforms, I like SoFi, because SoFi has a little bit more stable kind of revenues. The people there, they invest for the long term. They have retirement accounts. They have loans, mortgages, student loans. They don't have all these kind of option tradings and things that are very hard to predict. Now, if you look at Robinhood, it is trading at 21 times forward earnings, which is very cheap. But earnings per share growth is all over the place. 149%, 279%. This year is expected to be negative 10%. But if we have a massive crash, it could be negative 40 or 50%. And then the PE ratio that's looking at 29 times could end up being 40 or 50 times. So for me, Robinhood, I like what the company is doing. But to me, the stock is extremely hard to value because it's mainly a bet on a bull market. If you don't have a bull market, you have a bear market, or you have, not much action in the market, a lot of the Robinhood traders are going to give up and they're going to find another hobby to have fun with. And that's what happens in those markets. Now, for me personally, when I look at Robinhood, I like options on the stock. So if I'm looking at, the $25 put for January 2026, it's almost yielding a 10% return. So on this $25 dollar put, if you know a lot about options, you could get a 10% return to get to buy Robinhood at $25. Now, $25 is 43% on the downside from here. So Robinhood would have to go down 43% for you to get assigned on the $25 put if you want to own Robinhood. That's what I would recommend on the stock. For me personally, I would only look at doing options on the company, and I share more of that stuff in my own group. This is the link if you're interested. But as an investment, I don't like it too much. I prefer SoFi. It's more predictable and it has more longer term people on the platform. And that's how I look at it, guys. You know, not financial advice, just my opinion on those three stocks. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.